So today's episode, we're going to do question and answer. I've been getting asked a lot of the same questions lately on social media and just in the networking that I've been doing. So I thought I'd come on and answer just, some questions about the economy and the real estate market, things like that. So for today, we're gonna have that format, and going forward, I think we're gonna do question and answer episodes every couple weeks.
So the first question is, how is the Edmonton rental market? And honestly, right now, it's crazy. I never thought we'd see the demand we're seeing. Our portfolio, we're under 2% vacant, and that includes everything that's under renovation. I think we had one unit listed, and I just talked to the girl who does our leads, and she said on Saturday alone we got 45 calls for that one unit. So it's pretty wild, and it's in every building. I don't think that'll change anytime soon. We got really good migration, and we're kind of in that middle where it's $1,000 to $1,500 rents. So even if new supply comes in, it's really hard to compete with that price. Yeah, so it's a lot of fun when it's busy like this. We're actually showing units, like occupied units already, because people want them pretty much as soon as they're available. So it's fun. It's busy. Tons of demand. When we initially started the company, we pretty much until December of this year ran right around 5% vacancy, and that included everything under renovation. And now that's been cut in half, and it pretty much started for us at Christmas. It was from Christmas on, we've just had crazy demand. I think, a lot of people have been moving here, and I think finally the supply got eaten up, and now there's way more demand than there is supply. So the one question I get asked a lot is how we're positioned, to kind of weather the storm that may or may not come in the next couple months. Essentially, interest rates are so high right now because the Fed is trying to slow inflation. So hopefully we are very near the end of them raising rates or at the end of it. I think some of the bank failures in the States have helped so the Fed won't keep raising rates. We might see one or two more. But it's definitely made it a lot more difficult for people to finance. Your mortgage payment, your interest on your mortgage essentially doubled in the last, since they started raising rates. So if you had a 2% and you have a 4%, that payment difference is massive for people who own houses. Our existing assets, it really doesn't affect at all because we have all long-term insured debt. So most of our loans are actually for another 8 years. They don't come up for renewal. We have one that comes up, and I think it's in 3 years from now. So it won't affect our existing ones. As far as going out and looking for properties, it definitely makes it harder to finance. And we're in a weird spot where the rents, everyone can see that the rent growth in the next couple of years is going to be so high that they don't want to sell. So the prices haven't came down to adjust for the interest rates going up yet. And I think we've seen that in single family too, where your interest cost doubled and housing went down a tiny amount, if any, and that's just due to demand. And we're going to run into that where I think the only opportunity is going to be is people who financed, if you had an apartment building and you're at 2% interest and the debt's coming up today, to make the yield you want is like your interest payment is going to be double what it was. So it's going to be very hard to keep that asset inside of a fund or something. So I think there will be people who are just forced to sell. For sure, if they wanted to do a quick flip where they get in, get rents up, and pull their money out in 2 years, well, that plan just went out the window because now you can only get, a lot less of the financing you were planning to get. We want to be buyers throughout all cycles. It's just we have to find one that works. So I think now we'll start to see a little bit more stuff. I think everyone was kind of waiting to see what happened with interest rates and what happened with the market. I do think now we're starting to see whether it's the sellers, adjusting the price slightly to meet where interest rates are at, or just people are going to be forced to sell. When for sure some of the bigger companies, if they have it in a fund and they need to turn that money over every so many years, they care a little less about when they sell. So we're hoping there's some opportunity there, but it makes it harder as far as getting the yield you want. If you're buying at a 5 cap and interest rates are 5, there's not a lot there. There's a couple of really big companies that own a huge portion of the market share. And then we're kind of in between. There's a lot of guys who own 1 or 2 buildings, but those are the smaller, the 20, 50, 70 unit buildings. And we're kind of now in that that range that's right in between where it's, 100 to 150 units. So I think it's kind of a sweet spot for us right now because those are a little too small for the really big guys and a little too big for the small guys. So there's definitely other people in that market that we're in, but it's kind of a good spot right now. For us, the two things that we always look for when buying a property is it needs to have the scale and we need to be able to get the financing we want on it. For sure now, we really don't look at anything if it's, we want it to be around 100 units or bigger, and that's kind of the first criteria. And then a lot of it's on the number side. So even now we're going to see stuff where people are going to sell it and there's going to be debt attached to it, and maybe it's 60% loan to value or something that just doesn't make sense. So we want to go in and put new financing on day one. That's usually a criteria for us. Neighborhood's a big one. We want it to feel safe, and we generally stay away from downtown. I don't love that area. But yeah, it's scale, and then it has to make sense. We underwrite it and has to make sense on the number side. We don't do a ton of value add, so I don't want something where we have to turn over the whole rent roll and get new people in and run. We like stuff where a lot of the big heavy lifting's done. We go in and renovate the units and we definitely make the outsides look nice, but we don't want to do massive value adds. We're not trying to pull the money all out day one. We're long-term buy and hold, so we're looking at 10, 15 years of holding an asset. I get asked a lot the difference between what we do, which is stabilized value add versus a really heavy value add. So on a heavy value add, they're going in, doing tons of renovations, probably turning over every unit, trying to get the whole rent roll turned over, getting rents up a lot, and then trying to pull their money out within, maybe 12 to 24 months. We're long-term buy and hold, so we want to hold that asset 10, 20 years. Generally, if you're going in and doing the on heavy value add, you're taking temporary debt, you're buying the property, and then the idea is that you get all the rents up, and and then in 2 years, when you've got all the rents up, you go to the bank and finance it at a lot higher value than you originally paid. So you might be in that deal for no money in. So let's say you bought it for $10 million, now the value is 12, and you need to leave 20% in. You pull your $2 million out, you have no money in that deal, and you actually probably took money out. So if it works great, but there's a lot of risk in there. What we do is we're a cash flow stable is what we're looking for. So we want cash flow day one. We want to know our tenants aren't going to all leave. So, our it's always occupied. It pays us literally day one when we, the day we go and purchase the property. Generally, we get a check for rents collected that month and every month after that. There's never a huge exodus of people or of income. We usually, like I said, we use long-term financing, so there's no risk there that if interest rates double in the next 6 months, it makes our building no difference. If anything, it pushes people into the rental market and makes our building, has the rents go up, if anything. So our model, and I always say we kind of do like stabilized value add. So instead of doing heavy value add where you are going in and turning over those tenants, I just think there's a lot more risk there. So, and I think this was, a perfect example was in, the last year where if you had this business model drawn out and you had underwrote it at 2 or 2.5% interest rate, and you go in and start this huge renovation project and your debt's coming due in the next 18 months, let's say you took a bridge loan, then what happens when now interest rates are 5%? So you have such a long window of time. So for us, we want it to be really stable. We want to go in day one, put the financing in, and then we know what that looks like for the next 5 or 10 years. And you can still get all the rent increases, and if everything works right, you can still refinance money out in that window. But your financing is very stable, very secure. I just don't love the whole going in and doing heavy renovation. It's because you're gonna have you either empty the building out and do it then, or else you have half the tenants who are living in like a really heavy renovation project and they're not happy. And then if you're trying to turn the rent roll over and upgrade the tenants, you're going to have half that were there originally, and then you're moving in the new people. It's a lot more risky way to do it. It is quick, if everything goes good, it is quicker money for people if they want to just put money out and pull it out. That's just not the business we're playing. It's not get rich quick for us. Another question is why we look for properties that are 100 plus instead of just putting together a bunch of 10, 20 unit properties. For us, we have owned some smaller properties, but it's just the economies of scale and the ease of management. So if you have 10 unit buildings that make up your 100 units, you're going to 10 different locations. You have 10 roofs. You have 10 boilers. We also find that like the bigger properties just tend to have a lot less problems. If you have 2 bad tenants in an 8-unit building, it pretty much ruins it. Like everyone else is going to want out, and there's no sense of community. People aren't watching the doors. On a 100-unit property, there's people in and out all the time, and they really do. It seems to have that sense of community. You have one roof at that property. You have one set of boilers. You send the maintenance guy there. He can do 10 calls that day instead of sending him to 10 different locations. So pretty much everything at scale gets a lot easier. And then it's also what the exit is there. If you buy a portfolio of 10 unit buildings, you're trying to sell those, you probably one off at a time. It's going to be a more unsophisticated, smaller buyer who's going to haggle about every little thing. When you're dealing with a bigger property, you definitely have a more sophisticated or even institutional type buyer, and it makes that process a lot easier, even to buy them. If you think of the amount of time, I mean, if we put a 100 unit on a contract, we're going to close on that in 90 days. And unless you're putting all the 10s under contract at one time, it takes the same 3 months to close on that property. You still have to get insurance. You still have to get financing. You still have to get approved. You have to get your loan insurance, all of that stuff, but you're doing it 10 times. So just the manpower of it makes it pretty difficult, and I think it's a lot harder to manage it.
So that's it for today's episode. Again, we're going to try to keep these question and answer episodes a lot shorter than the full length ones. So if you guys have any questions, make sure you reach out and let us know what they are, and we'll be happy to answer them.